Welcome everyone. This is the first module on rural credit market. In this module, we shall learn number 1, who are the major agents in the rural credit market. Number 2, what are the major problems in the rural credit market? And number 3, what are the major characteristics of the rural credit market? So, let us start our analysis by asking a question: what constitutes the rural credit market? Now, as we all know, every market is characterized by a demand side as well as a supply side. Now, to talk about the demand side of the rural credit market, we find that in the rural credit market, credit is demanded, number 1, for fixed capital. That is, capital required for new startups. Now, these startups use this capital to purchase new inputs like land, agricultural machineries and tools, warehouses, etc. Now, capital is also demanded as working capital. This means the credit required for ongoing production activity. We all know that at the beginning of the crop cycle, peasants need money to purchase seeds, fertilizers, pesticides and so on. However, farmers do not have sufficient funds to purchase it, as they get money only after the products are sold. So they need to borrow and they repay it after the crop is harvested and sold. The third type of demand for rural credit is consumption credit. That is, the credit need arising from poor individuals who are strapped for cash, either number 1, because of sudden downturn in production, sudden fall in prices of their products, increase in consumption due to illness, death and festivities like wedding. Number 2, owing to the inherent uncertainty in agricultural production, there can be significant crop failure resulting into temporary hardship. Earnings in agriculture can fluctuate. This can raise the demand for credit. Number 3, farm wages are typically lower in lean season relative to the harvesting season. Therefore, in the lean season, there can be high rate of unemployment, and these unemployed people may require credit to smooth out their consumption. Now, after talking about the demand side, let us consider the supply side. In the rural credit market, there are 2 suppliers of credit: institutional lenders or formal lenders and informal lenders. Now, institutional lenders include government banks, credit bureaus, special banks set up by the government to cater the needs of the rural population. On the other hand, informal lenders are local money lenders, landlords, relatives, traders and friends. Now, given the coexistence of both institutional and non-institutional lenders, what we find in the rural credit market is the dominance of non-institutional form of credit. That is, the informal lenders dominate the credit market. To give evidence in favor of this argument, let us now consider the case of three countries, Thailand, Philippines, and India. In Thailand, we find that traditionally the rural people used to get their required credit from local village moneylenders. In the post-war period, recognizing the importance of agricultural development, rural credit expansion was introduced as an integral component of rural policy. In 1966, the government of Thailand founded the Bank of Agriculture and Agricultural Cooperatives. In August 1975, the Bank of Thailand circulated a memorandum to all commercial banks to lend at least 5% of their total stock of loans to the farm households. Now, despite such series of attempts, even in the late 1980s, informal loans accounted for 50% of total loans. What about Philippines? In Philippines, like all developing countries, there was a developed formal system of credit under the direct supervision of the Central Bank of Philippines. There were commercial banks, thrift banks, certain specialized government bank and non-bank financial institutions such as investment houses, insurance companies, financing companies, and securities market. However, at the same time, it also had a sizable informal sector consisting of relatives, friends, credit cooperatives, rotating savings and credit associations, and array of landlords, millers, traders, and other agents. So far, we do not have a proper estimate of the relative importance of informal sector in Philippines. However, as the diversity of informal sector suggests, its size can be quite large. The informal sector is significantly diversified. There is a personalized system of financial flows among relatives and friends, which largely addresses day-to-day cash flow problems to meet consumption and production need of households. Now, these loans are given without any interest. At the same time, cooperatives, credit unions, rotating savings and credit associations use pool funds to make loans and sometimes provide other financial services to their members. There is also a complex structure of trade and production credit provided by the input suppliers. There is also considerable interaction between the formal and informal financial institutions. The lenders operating in rice and coconut producing villages has been observed to get loans from banks. Traders, commission agents, and rice millers involved in rice marketing also use banks as an important source of loanable funds. What happens in India? In India, during 1950s, only 7.2% of the total borrowings came from government sources. By 1981, the number has jumped to 61.2%. Thanks to the Indian government's substantial drive to extend rural credit through official channel. However, still 24.3% of the debts in the rural sector are provided by the individual moneylenders. Now, given this, the next question that arises is, why informal moneylenders are so prominent in rural credit markets. The dominance of the non-institutional form of credit in the rural market can be attributed to certain problems that exist in the rural credit market. Now, if we look at the operation of the rural credit market, we find that after providing loan, it is very difficult to find out what is being done with the loan. Now, this gives rise to two possibilities. The first is the possibility of involuntary default. That is, there is a high chance that agricultural production may be so low that the borrower may be unable to repay the entire amount. However, at the same time, there is also a chance of voluntary or strategic default. In this case, the borrower has the capability to repay the loan, but it does not find it in her interest to do so. Why can that happen? The major reason for that is the presence of what we know as limited liability. Now, what limited liability is? Limited liability is actually a legal agreement that ensures that if Y represents the amount of output produced and B the amount borrowed, then the return to the lender R is actually minimum of Y and B. That means if the borrower borrows say rupees 1,500 but is capable to produce output of value say 1,000, then the borrower can get rid of her entire liability by paying only rupees 1,000. Now, if this is the case, then in agricultural sector, borrowers can take the benefit of limited liability either by misrepresenting their output value or by siphoning off their loan for purely consumption purposes. So, there is a need to introduce a proper system of surveillance. The problem with the formal lenders in this regard is that the formal lenders do not have such personal knowledge regarding the activities of their clients. They therefore cannot monitor how the loan is being used. At the same time, due to the inability to monitor the lenders, can also lead to a situation of excessive risk taking. Now, how can we justify excessive risk taking? To find it, let us start with an example. Suppose there are two projects, both of which have a startup cost of rupees say 1 lakh. The prevailing interest rate is 10%. So, they have to repay rupees 1 lakh 10,000. There are two agricultural projects, one with an average rate of return 15% and the second with an average rate of return of 20%. So, apparently, the second project seems to be more attractive. However, the nature of the projects are different. The first project is uncertain and provides a return of rupees 2,30,000 with probability half and rupees 0 with probability half. On the other hand, the second project is certain. Now let us consider the expected return from the two projects. For the first project, in case of good state, the return is 2,30,000 minus 1,10,000. While for the bad state, the return is 0. As a result, the expected return will be rupees 60,000. What for the second project? For the second project, the return will be 1,20,000 minus 1,10,000. So, it is 10,000. So, even if the average return from the second project is comparatively higher, the first project is much more attractive. So, there is a high chance that the first project or the risky project will be taken. Now, the inclination towards the risky project and the subsequent high chance of default makes lenders extremely sensitive. So, they look for some amount of collateral to get rid of such problem. However, the institutional lenders have certain problems regarding this collateral. A farmer may have a small quantity of land which she is willing to mortgage. But the banks cannot find it as acceptable collateral because selling of some such small piece of land is quite difficult for them. However, given the wide array of informal lenders, there is a high chance of getting right sort of lenders who may be ready to accept the collateral. For example, a large landowner who has land adjacent to the poor farmer may be interested in that tiny plot of land. A landlord has better chance of knowing what her tenant is doing with the loan. A trader who advances loans for working capital often has the first claim on the borrower's output. She arrives at the field with her truck at the day of the harvest. So, there are certain features which are beneficial for the non-institutional lenders which the institutional lenders cannot cope up with. Now, given the problems with the institutional lenders, let us now move to our next question. What special features do we find in the rural credit market? Now, if we look at the rural credit market, then we find 6 important features. The first feature is related to informational constraints. The rural market is characterized by the presence of substantial informational imperfection. Informational gap in this market occurs at 2 levels. First, there is substantial lack of information regarding the use in which a loan is put. Second, there is lack of information regarding the repayment decision. The second important feature is segmentation. The rural credit market has a tendency towards segmentation. A typical rural moneylender generally serves a fixed clientele whose members she lends on a repetitive basis. She is extremely reluctant to lend outside this circle. Most often, moneylenders' clients are from within her village or from close by. This ensures that the moneylenders has a close contact with them and is well informed about their activities and whereabouts. So, repeat lending is a common phenomenon. The third feature is interlinkage. Rural credit markets often exhibit interlinked credit transaction. This means instead of crafty informal moneylenders specifically engaged in lending money at exorbitantly high rate, majority of the village lenders do not pursue usury as their sole occupation. Most of the lenders are wealthy landlords tending to give credit to their tenants. They are shopkeepers or traders giving loans to the clients from whom they purchase grains. The fourth characteristic is interest rate variation. The informal interest rate in the rural credit market exhibit great variation. The rates vary depending on geographical location, source of funds, and characteristics of the borrowers. For example, in the Chambar region of Pakistan, the rate varied from 18% to as high as 200%. The fifth characteristic is rationing. Informal credit markets are characterized by widespread rationing. There is an upper limit on how much a borrower receives from the lender, despite the willingness of the borrower for higher amount of money, even at a higher interest rate. The sixth characteristic is exclusivity. Most of the informal credit markets are characterized by exclusive dealings. Moneylenders typically dislike situations in which the borrowers borrow from multiple sources. They insist that the borrower deal with them exclusively and approach no other lender for supplementary loans. So from this discussion, we learn certain things. First, in the rural credit market, borrowers ask money for fixed capital, working capital, or for consumption. There are both formal and informal lenders in the rural market, but there are various reasons for which the informal lenders dominate the rural credit market. The presence of informal lenders have given the rural credit market certain distinct features. So this is what we have for this module. Thanks for watching.